Hello, how are you? These two videos are the best course you can find for trading. In the last video we talked about liquidity and its kinds. In this video we are going to talk about how to trade with manipulation boxes, sessions as liquidity, and liquidity as zone enhancer. Your support is much appreciated, so get sure to subscribe, comment and like the video. Let's talk liquidity.
Mehran's here, your trading companion, and we want to talk liquidity today. Liquidity is like gunpowder in the markets. Who can use it properly can ride those strong and explosive moves. How many times you entered a trade but it hit your stop loss and then started to move in your direction. So, or you use liquidity or you get liquidated. We are going to talk about what is liquidity, what is manipulation box and how to use it. We use sessions as liquidity, so we talk about them as well. And we are going to talk about liquidity as a zone enhancer or as a POI enhancer. What is liquidity? In simple words, it means how easily an asset can be bought or sold. So where on charts that are a lot of money there is a pool of liquidity. All the important highs, lows, support and resistances, round numbers, and every price that there is an interest by a lot of traders is going to be a liquidity point. In the last video named Ultimate Liquidity, we talked a lot about this concept and I forward tested a strategy using manipulation boxes and entry setups. So let's learn that strategy first. What is a manipulation box? As I said, markets use grab of liquidity as fuel to move in a direction impulsively. So first it grabs a liquidity pool and then spikes downward or upward. So its fuel is burned out and it needs more fuel for the next movement. One of the obvious ways to create and absorb fuel is making manipulation boxes. For example, here you can see that the market moved downward impulsively and it broke a structure here. So we have our break of structure and our imbalances that I'm going to talk about. And then what happens? Market creates its manipulation box. Why it needs this manipulation box is that the manipulation boxes are injection of money into the market. It grabs it here for our first entry and it grabs it again for our second entry. Don't confuse yourself. We are going to talk about manipulation boxes, how to mark them and how to use them in this video. In lower time frames, it's just a channel, trend line, a trading range, or any other price pattern which you learn in kindergarten to amuse with, like triangles, megaphones, circles, I don't know. It's a compressed price action in lower time frames. It's not a spike there. So we shouldn't have a spike in these kinds of price action that we are going to name manipulation boxes. So how to mark manipulation boxes? After a spike with 2 or 3 imbalance candles, you should look for the first candle opposite of the spike and the second candle opposite of the current movement. This current movement should be choppy and don't have an imbalance. What I mean? First we have, for example, this impulsive move to the downside. After that, we mark the low and the high of first reversed candle and second candles of the next move after the spike. First reverse candle is here. Why? Because our spike is downward and we have our first reverse candle here. But we want the next reverse candle be opposite of this current move after the first candle. For example, if the move is to upward, we want that candle to be a red candle. But if the movement after this candle starts to go down, we want another green candle. opposite of that downward move after this spike. And we mark the low of the first candle or the high of the first candle and the low or high of the second candle opposite of the current movement. But you should make sure that the movement doesn't have another imbalance in it. It's like a trading range in lower time frames. Our manipulation box is ready for stop hunts. So after a stop hunt, for example, here or here, we are going to look for our entries. These boxes is being used as inducements for breakout traders, channel traders, trading range traders, and every other choppy trader that tries to take choppy entries. But those borders of that box are just traps, and we wait until the stop hunt of one side happens. After that, we try to take a reversal entry on lower time frames, for example, a 5-minute entry on a stop hunt of a 4-hour manipulation box. Let's see these concepts on charts and see what is an imbalance. How we mark and use them? You can see that we have our spike here. We have our first reverse candle here, and the second reverse candle is going to be here, and after that this shadow is going to be our manipulation box. So every kind of a choppy trading range like movement is going to be our manipulation box. After that, you can see that you can trade this high. It grabs the liquidity, provide us with an entry, and comes to the downside. And you can see that it grabs the low of this box and goes to the upside. So we have our manipulation box again from here to this high and these highs as well. And you can see that after grab of this low, it is going to explode to the upside. After that, we are going to have our manipulation box again from the low of this downside movement and the high of the next reverse movement to this current movement. It has its imbalances, but this imbalance is very substantial. We can mark that as our liquidity box or manipulation box as well. You can see that it grabs the high, so we extend this. It is an entry here for us, and it comes down. It grabs the second phase of the liquidity or the second manipulation box, and it again give us a good entry here. It comes down, it grabs this with a shadow, and it explodes to the upside. Even in the middle of this manipulation box, we have our first reverse candle here and our second reverse movement from here in this shadow. So a movement is enough. It doesn't have to be a candle. It is a substantial movement to the upward. So it is our manipulation box, and it grabs this low and it explodes to the upside. But how to enter? Let's see how we use these entries and trading setup. You can see that here we have our imbalance here. Let's talk about this entry. We are going to mark our first reversal candle, which is here, and the second reversal candle, which is here. When the market hits the stop loss of the sellers, this high, we are going to go to the 5-minute time frame. I use 4-hour and 5-minute with each other, and it provided us with an entry here. Do I take this entry? No, I don't, because it is not the liquidity entry I'm looking for, but it's the first kind of entry that I talked about. The market went up, it broke this internal structure with this imbalance. We can enter on this imbalance and put our stop loss higher than the candle that created this imbalance. But I don't take this trade because my setup is these kinds of movement plus liquidity. Let's see if it provides us with the other trade. Here is going to be my entry, and it's a good trade as well. So in either setups, in either ways you try to capture this movement is going to be okay, because here we can say that Here is our point of liquidity, and we enter on the high of that candle, and it is going to provide us with a good reward to risk ratio. You can see that here, high of this candle, this green candle, is our point of liquidity. Here is our imbalance, because it is the place between this shadow and this shadow, and we can enter on that imbalance, and it provides us with a high reward to risk ratio. Let's see the other entries here. It should first shift on the lower time frame. I mean, the market structure should shift first, and after that we are going to search for our setups. You can see that it shifted here. It is our imbalance, it is our point of liquidity. It is going to be a trade that I'm interested in investing in, and here is our imbalance. So we can enter here and put our stop loss here. We create our order here, and here is going to be our fill. You can see that. How does it work? It's a great straightforward strategy. We can go to 4-hour time frame. It's the trade. You can see that how great is this strategy. And if this candle hit this low, we can look for buys, because it grabbed the liquidity of high of this range and it grabbed the low of this range again. Does it provide us our entries? Maybe we take a stop loss here. It is okay to have losses. You become a great trader when you used to these kinds of losses. Maybe we take a trade here, we take a losing trade here, and here under this low or under this low is going to be our entry, or here. So when we are near our POI, we can take continuous trades. What I said about the concept of the shift plus liquidity setup, I mean entry setup, that I talked about in that ultimate smart money trading video. I said that you have an imbalance, you have a point of liquidity, it grabs and it moves. You have an imbalance, you have your point of liquidity, and it grabs and it moves. So where is our point of liquidity? It is going to be here. Where is our imbalance? It is going to be here. So we can enter under this low for the stop loss lower than this candle that made that imbalance, and you can see the result. After that, we have another entry here. Here we have an order block. Why I take these kinds of trades? It doesn't have imbalance, but first it printed this imbalance in the way up, and secondly it has its imbalance in lower time frame. These large candles has imbalances in lower time frames. I think it doesn't have the data I need for that trade. Anyway, let's see the result of that trade. It grabs the liquidity and it explodes to the upside. We can enter under this low. I'm going to show you the schematic one more time. You can see that. So the market, for example, is going to downside. It should come and breaks an internal structure. For example, here. When we have an imbalance here, you can enter right on this imbalance and put your stop loss here. So our first entry is going to be here, but you can enter under this point as liquidity as well. What is the difference? Sometimes the market doesn't come and grab this liquidity, it just reacts to this imbalance. But when we have a point of liquidity, our win rate is going to be higher. Sometimes the market just comes down. I mean in this point, not this point. Sometimes it just comes down and hits our stop loss. But when we have a point of liquidity, our probability is going to be higher. So we enter on this setup. You can take a picture of it right now. I'm going to pause a little. Or on this setup. here or here, but here we have an imbalance. I don't care why, but sessions, especially Asian sessions, highs and lows, or important high and low in the middle of the session is important point of liquidity. Now for marking sessions highs and lows, you just need to go to indicators in TradingView and type Asian range by Nico. You can add just one range and modify it to your sessions timing. For example, in New York it's 1832 1 a.m. I'm sorry, let's find that. I marked that time frame for Asian sessions, and for other sessions you should go to indicator and add two more Asian range by Nico. It's a good indicator. And you can do it for London session. 2 to 440 is good. And even another for New York session. It is going to be okay. And you can modify it by clicking on that setting button. I'm going to change the color of London to blue. And this one to, for example, yellow. So you can add 3 Asian range indicator for your 3 sessions. How to use these sessions as liquidity points? The most important part of session is its low and its high. For example, here it is Asian sessions. We are going to talk about only Asia in this video. You can see that the high of Asian session is there and the low of Asian session is here. And it grabbed the high of Asian session. It provided us with a setup and it broke down. And in the low, it did that again. But how to use these kinds of trades? First, you should identify a good POI or point of liquidity on the high and on the low of the Asian range session. It is a point of liquidity here. Why? Because a lot of traders try to catch these movements. You can see those shadows here. When we have many open and closes, or we have many long shadows, or we have, for example, a long shadow like here, it's a kind of inducement as well. You can see that here happened again. Anyway, so it's a point of liquidity. Believe me, it's a point of liquidity and inducement when we have a lot of shadows here. So we should find confluences with Asian range liquidity and order blocks, liquidity points, support and resistances, round number. We don't try to use them and grab those movements only by using Asian range liquidity or other sessions liquidity. That is not going to have good results with just using sessions liquidity. But we can see here it came down, grab that liquidity, and we want to try to grab our kinds of setups. If you want to trade with only imbalances, shift and imbalances, you can see that here we have our shift. Here market shifted to the upside, and here we have our imbalance here to here. So we can, for example, enter on the middle of the imbalance. When your imbalance is large, you can just put your entry on the middle of the candle of imbalance. You can see that it is going to provide you with a good setup. And when it grabbed the high of the session liquidity, we are going to wait for shifts and liquidities. Here we have our shift. When we have a big imbalance and we have our internal market structure broken, we have our shift, and my setup is going to be here. I swear to God, I don't go back and see these kinds of setups first. I just forward test them always like here, and I take sometimes stop losses. I'm not a scammer. Here is our shift plus imbalance. You could say we have our setup here. Anyway, it is our shift, and we have a lot of big candles here. The big candle itself is an imbalance. You can count that as an imbalance, and on the high of this shadow as our liquidity, we can enter. I don't care about these setups. It sometimes works, it sometimes doesn't, but it is going to be consistently profitable for you. We are just talking about sessions liquidity, and you can see that it grabs the high and it comes down. Is that okay? We want to see the concept working. About setups, about other order blocks, about other concepts, other kinds of setups that we are going to use to trade with, we are going to talk about them in the channel. Here we just want to test one concept, and we can see that here it came down, grabbed the low of Asian session, and it went up, grabbed the high of Asian session, and it's working, and that's enough. So here we have our Asian range. It's here to here, and where is our order block or point of liquidity for finding confluences with Asian range? You can say that here is our order block, and here is our point of liquidity. So we take these kinds of trades after it grabs the high or low of the Asian session. It's the first touch. Let's see if we have a stop loss here or not. It's not a good kind of setup. Why? Because yes, we can enter here and put our stop loss here, and it is a stop loss. It doesn't matter. You have a stop loss here. How much is that? It's just 1% of your account, because you are going to have just one stop loss here. But we don't enter in these kinds of situation. In which situation? You can see that we don't have any imbalance here. It came up, it filled its imbalance, it came up, it filled the imbalance, it came up, it filled the imbalance, and it came up. And our point of liquidity is going to be here. And we don't have any imbalances here. Why an imbalance is important for us? Because imbalance is pure buying or selling orders. And when it gets filled, it is used, and it doesn't interest us to trade. But when we go forward into the middle of the London session, you can see we have our point of liquidity here. You can use this imbalance and order block for your stop loss, but we have an imbalance here. If you pay attention, you can see that it is the space between this red candle and this green candle. But anyway, it is a little risky to put your stop loss right here. I'm going to put my stop loss under the next imbalance or the next candle that made that move. For example, I'm going to put our entry here, and we are going to put our stop loss here. So I said that don't care about your stop losses with my smart money trading. With Neo smart money trading methodology, you had one stop loss here, but you can see the result. You have a trade, for example, 10-15 reward to risk ratio. Anyway, let's go and see other opportunities. Here it grabbed the high of Asian session. We are going to see if we get stop losses. Here we don't have any stop loss at all, and it is a wonderful trade. Let me see that. It's the Asian session. It grabbed this Asian session right here. Here, let me show you. It is the line of the Asian session. It grabbed the Asian session here for the first time in this point, but it didn't shift the market structure. It grabbed it again. It didn't shift the market structure. It grabbed it again, and it shifted to the downside. You can put your trade in the imbalance here. It is that situation that all the confluences are in the same place. We have our imbalance here, and we have our line of liquidity or point of liquidity here. So we can enter here on this shadow, I mean above these shadows, and we can put our stop loss on the candle that made the move and imbalance or on the high. And what happens? Again, let me see that and see the right place for our stop loss. Let's see the result. The best reward to risk ratio to close your trades is 4-to-1 reward to risk ratio. You can keep these movements. For example, it's more than 15-to-1 reward to risk ratio, but I don't care about the rest of this movement. I just want a 4-to-1 reward to risk ratio, and it gave us the 4 and it went up, and we didn't have a stop loss yet. You can say we have a 21 reward to risk ratio from this trade. Anyway, the other concept I wanted to talk about is the important highs and lows in the middle of any session. You can use the high and lows of all the sessions for liquidity, but the Asian session works better. But sometimes you should pay attention to the movement of the Asian session. You can see that here we have a substantial move to the upside. We have our order blocks, we have our imbalances, for example here. So in these movements we want to see the lows of heart of Asian session to get broken. Why I say with no smart money you are going to be a monstrous trader? Because all the other smart money traders are going to count these order blocks to enter the trades, but we are waiting for them to get liquidated, and we enter when their stop loss is hit, for example below this shadow or below this shadow. It's a rejection block, it is a valid rejection block, it's an order block. And when the market hit their stop losses, we are going to enter the market. Let's see another example. You see that always it happens. It's the high or low of the middle of the session. But here, it grabs the high of Asian session. What we want to see? We want to see another liquidity to get taken, or we want to see another POI. What we have here, you are going to see the market like me in the future. It is a 1 hour order block or a 4 hour order block, I don't know, but it is a order block. You can see that here. So it is a POI for us, and it grabbed the high of the Asian session here. It grabbed an inducement point here. You are going to learn about inducements in this channel. It grabbed this high, it grabbed the inducement, it touches the order block of higher time frame. So we have our confluences. We are going to go to the lower time frame, and when the market shifts, we can trade. We can trade here on the imbalance, or we can trade on these highs. For example, it didn't give me the setup I'm looking for here, but you can trade with market shift and imbalance here. I use market shift, imbalance, and liquidity setup. You can use both setups. I just like that setup much more. And if we want to take continuous trades, we have our points of liquidities, for example here, and we have our imbalance here. So it is the setup I like. I'm not scamming up these results. I just talked about two kinds of setups that we are going to take, and after that I taught you a concept named liquidity of session. We are combining them with each other to test them in a chart, and you can see the results. I don't blabber in these concepts. I'm just testing the concepts that I'm providing you with. So we want to have confluences with Asians highs and lows, and other concepts like liquidity points, like other sessions, highs and lows, like support and resistances, order blocks. So make sure to subscribe and watch all of the videos of this channel, because there are a lot of concepts you can find those confluences with. The next concept in liquidity points is liquidity as POI enhancer. POI, or point of interest. Point of interest is the zone or price that we are interested in investing. Me and my students have a golden sentence: no liquidity, no trade. I mean the actual liquidity, not the normal movement of price that gurus call it liquidity. They just heard about liquidity and don't know what is it really. They are scamming you with a concept that they don't know what that concept is. For example, we can see that the market is doing its normal job. It is going to move up and it shifts down to the downside. And other traders or other gurus think that it is a point of liquidity, and they say that it's a grab of liquidity. No, it's the market movement. It's the simple way of market going up. So it is not a point of liquidity. Yes, it is a point of liquidity, for example, but it is not. I call these kinds of liquidity soft liquidities, and this kind of liquidity hard liquidity. So if I say it grabs liquidity in this picture, it's the soft liquidity. It is not the liquidity really. It's just because I had some gurus that I was working with them, or I was watching their courses. I learned these concepts from somebody anyway, and they call these kinds of movement a liquidity, and it just has its place in my mind. I can't erase that. So when we call this liquidity, it's just soft liquidity, and when we call these kinds of liquidities, it's hard liquidity. Why? Because it did something, it breaks the structure. So when we are talking about the liquidity concept, we are talking about these kinds of things. We are talking about sessions liquidity, old highs and lows of daily, weekly, 4-hour structure, the structures that break another structure. Those kinds of liquidity is the real liquidity or manipulation boxes. Anyway, an order block, support or resistances, and any kinds of POI or point of interest should always have liquidity after it. I mean the kind of liquidity that I was talking about, the hard liquidity. And if it grabbed liquidity before creation, it has higher probability compared to other POIs. For example, we have a POI or an order block here. Why it is important and it provides us this substantial movement to the upside? Because first, it has liquidity to grab. We are going to try to take this trade as well, but the main trade that we are interested in is when it comes down, it grabs this point of liquidity, this low, and it hits this order block again, and it goes up. But other gurus, what they say? No, it touched our order block, it is mitigated. I don't know the bullshits they use, but it's a very strong movement here. It's a wonderful setup here. It's mitigated. I don't know what mitigated into it, but it's a strong setup here. You can even enter aggressively here without any setups in lower time frame here. Why? Because it has liquidity to get up, and it has hard liquidity. Why? Because it broke this minor structure to the upward. It comes, grabs its liquidity, it shifted to the upward, it comes and fill the imbalance, and boom. We are going to talk about all these concepts in this channel. Have the channel, subscribe, and don't confuse yourself. We are going to talk about these concepts in details. And it grabbed liquidity before creation, so it is a higher probability order block. You can see that we have a liquidity point here, 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 and it grabbed all these liquidities. It shifted the market upside, I think. Anyway, it is going to go to upward this order block. I mean, why? Because it made a new high, it couldn't break the low here, it made another high, and it comes and grab the liquidity. So even if it doesn't shift the market, but it's a higher probability order block, it grabbed the liquidity and it has liquidity to grab. It's enough for today. I talked about a lot of important and working concepts in this video. I forgot to say you should pay attention to the sessions of your market. For example, if you trade crypto, if you trade your country's stocks, the sessions are different from forex sessions, so the timing of session is different, but the concepts are the same. And another thing, I'm in Iran, I don't have internet freedom here. I can't access to markets every day. That's why I teach, because for teaching I just want to have an internet connection at 2 a.m. and I can upload my videos, or I want to have a webinar and I schedule that in the nights. That is going to be your morning or your afternoon or your nights as well, and I can access to internet, but I can access to the internet freely in the days, even we are under the sanctions of TradingView. So it's a hard time for me, and your supports, your subscribes, your likes and comments is much appreciated, and in return I'm going to make a monstrous trader from you. Thank you for your watching. Pay attention to playlists. We have several playlists. I have a technical analysis playlist that I'm going to teach you the basics of advanced technical analysis, because that works well in crypto and stocks market. And for high cap cryptos or forex trading, I'm going to teach you new smart money concepts, and those playlists are separate. And watch the videos consecutively so you don't miss a point. Anyway, thank you for your watching. I like teaching and I'm going to teach you so many things. Have a good day and goodbye.